Summary. Everyone wants the best mortgage rates, however, most people end up with just about what they can manage. This is due to the several factors affecting mortgage which are always different for each person. If you have a great credit history, there are chances that you could close your mortgage with the best rates you will ever imagine. However, that might not be possible depending on the property type you're going for. To get the best rates, you should consider getting quotes from multiple lenders. You should also consider government-type loans like VA loans meant for veterans, active military members, and their surviving spouses, or FHA loans meant for first-time buyers that would not be able to get approval for conventional loans. This video will not only educate you on the factors that would affect your mortgage rates, but also give you the right information on how to get the best rates by working on the listed factors. Almost everyone on their way to get a mortgage are more interested in getting low down payments and lower interest rates. While most lenders would advertise juicy rates, they are mostly unrealistic because you would need to be among the few best of Americans with a great financial history to get them. Since you're not one of those people, you should know the factors that affect mortgage rates and how to work your way around them so that you will be able to negotiate your way to get the best rates. Factors that affect your mortgage rate. 1. Credit score. Your credit score plays one of the most important roles in determining your mortgage rate. In fact, it could give you those unrealistically low rates you see lender advertising in commercials, or it could give you the worst rate that you will struggle to pay off for years to come. Lenders use your credit score to determine how much of a risk you are and how reliable you'll be when repaying the loan. Your credit score is calculated based on the information in your credit report. In your credit report, you find all the information about your credit history, including your credit cards, payment history on debt, and other loans. You can check your credit report by requesting it from all 3 credit agencies: Equifax, TransUnion, and Experian. Look out for errors in your credit report which could affect your credit score. Make sure these errors are correct and your credit score updated before you start providing your financial information to private lenders. 2. Property location. State laws do make an impact on the cost of a home and the mortgage rate the lender would be interested in offering you regardless of how eligible you are for the loan. This means you can get lower interest rates in a state while going almost double the interest rate for a home of the same value in another state. There are many tools online that you can use to find the interest rate you're most likely to receive based on your state, loan amount, loan type, and country. Take note that these tools will only provide you an estimate which could be close to or widely differ from what your lender will offer you. The best way to get a decent rate based on your property location is to talk to different lenders. 3. Property price and loan amount. The interest rates on loans would depend on the cost of the home as well as the loan amount. The loan amount is the amount you'll need to cover the purchase of the home, which is the actual home price plus closing costs minus your down payment. Depending on your lender and mortgage loan type, your closing costs and mortgage insurance, if any, could be rolled into your mortgage loan. Rather than going straight to the market to start shopping for homes, it would be best to first get pre-qualified for a mortgage, which gives you an idea of how much you are eligible to borrow. This should give you an idea of how your interest rate would look like. Try this with different lenders to get a better rate. 4. Down payment. Whenever lenders give borrowers a huge sum of money to cover their mortgage, they are always taking a risk, which is why riskier borrowers have to deal with higher interest rates. The amount you pay as down payment can also determine how risky you are and what your interest rate would be. Down payments are usually from 3.5% up to 20%, however, you won't want to go for the 3.5% option. If you want to get a lower interest, you should put 20% or more down. This might not be possible through your lender, but you could purchase mortgage insurance, also known as private mortgage insurance, PMI, which protects the lender in case the borrower defaults on loan payment. This would add to the overall cost of your monthly mortgage loan payment, however, it would reduce how much you have to pay every month in interest. You won't really have to commit more than 20% in down payment to get a lower interest rate. Try to get quotes from as many lenders as possible to know more about your potential interest rate. 5. Loan term. The duration of your loan could also determine the interest rate or mortgage rate you will be given. This refers to how long you have to repay the loan. Shorter-term loans attract lower interest rates and lower closing costing, however, you would be making higher monthly payments on these loans. 6. Loan type. There are several loan types that come with different loan terms. Conventional loans are stricter and you might have to pay higher interest rates if you barely meet the requirements. FHA loans are guaranteed by the government and designed for first-time buyers who would be unable to meet up to private lenders' requirements. VA loans are guaranteed by the Department of Veteran Affairs as well as other kinds of loans. Some loans offer generally high interest rates while others offer lower interest rates. 7. Property use. This is not general, but in most cases, houses that will be used as a primary residence will come with lower rates while investment properties will have higher rates. Not all lenders will inflate your interest rate if you're going for an investment property. In some cases, the fact that you're going for an investment property makes you more reliable as you would be offering a better credit score and more assurance that you would repay the loan on time than someone going for a primary residence. 8. Economy. Regardless of your credit score or financial status, the economy can determine what your interest rate will be. In fact, interest rates aren't what they used to be in the 2000s. With the coronavirus pandemic that stalled the US economy, lenders are more cautious when handing out loans. This means you will have to meet some strict requirements or your interest rate will be higher than usual.